All right, guys, welcome to our podcast or our webinar. My name is Alex. I'm here with my colleagues Thong and Wesley, and today we're going to be diving into investing in the real estate during crisis. Next slide. Welcome to the Asset Team A webinar. Before we dive into the overall topic, just some facts and news for this week. So the value of the US dollar has depreciated 9% from its March highs and is on record for the worst month since 2011. This is mainly due to the monetary supply, as the Fed has printed around $3 trillion worth of money. So this decrease has also pushed the price of gold to record highs this week. Today, the CEOs of the biggest tech companies in the world, Facebook, Amazon, Google, and Apple, are appearing before the House antitrust panel as they dive into whether some of their huge companies needs to be broken down. And finally, stocks had an interesting day yesterday, Tuesday, as many companies reported mixed earnings, and talks about the next stimulus wave continued on. Next slide. And so now we're going to jump into the impact of a crisis on real estate. So we're going to start with the Great Recession. So the Great Recession in 2008. So the Great Recession in 2008 was a housing bubble that followed the technology bubble burst and the 9/11 attack in 2000. So this is where interest rates essentially plummeted and strict lending requirements were abandoned. And the bubble burst after 6 years of this strict lending requirements that were thrown out the window, which led to housing prices to drop 40%. And foreclosures around the country occurred as people could not afford the interest payments on their loans. So essentially, the banks were just allowing anyone who could not actually afford their interest payments to get to qualify for these mortgage payments. So this led to regular people buying houses that were out of their budget. And after a while of just drawing on max credit scores, a lot of people couldn't afford this, and this led them to foreclose, and the banks gobbled up a lot of the foreclosures around the country. Next slide. So how a crisis will impact now. So since 2008, real estate market has been stabilized. The government has stabilized it with loans, and the price has been steadily rising ever since 2008. On average, appreciation on these properties in the past decade since 2008 has been averaging 2 to 5%, even in current market conditions today. So even if you're looking at the past couple months or so, appreciation is still continuing in the major cities and all over the country, even the fact that we're in a major pandemic right now. And finally, we were thinking returns for investors. This is our prediction for the foreseeable future. Will be better in a secondary market than a primary market. As for the future, virtual work becomes more prevalent. There's no need to live in these larger cities. So once coronavirus isn't going to end for a while. I can't see it going away, but even once it does start to die down, I can see it just changing the entire workforce, and it kind of shows that you don't have to come to office every day and you can work off your laptop. And I think this will impact a lot of these hot major cities where people don't actually need to live to go to work, as they can just work from their laptops and save money by living in a secondary market, which isn't one of the hot cities like Boston, New York City, LA, Tampa, etc. Next slide. So now we're going to delve into why should we invest. So why should you, as an investor, as a regular person, invest in real estate over putting your hard-earned money into something else? And that's a very good question. So the first sort of point we have is a stable source of income. So people always need a place to live. It's the benefit with real estate. Land is not infinite. And especially during a lockdown, people need to stay at home more. So people in the past couple of months have just been at home. And this means that a recession does not necessarily affect the housing market like other sectors such as oil or stock market. You can honestly just say that by looking that up in the past couple of months during this recession, it has not affected the real estate market like it has in stocks. There was not a huge down crash. This is not like 2008 recession. Has no really the only big thing it has on real estate is if renters can afford to pay some of their rent, which I'll dive into later. And next slide. And next we have real estate appreciation. So real estate can return, while it does return annual appreciation, as I mentioned earlier. So real estate properties can increase in value and will increase more if renovations are carried out. So a lot of times as a real estate investor, if you buy a property, you renovate it, you put in some sweat equity, you can honestly, more times than not, if you found a good deal, you can sell it for more than the amount of money you can put into it. And so that just goes on top of this real estate appreciation, which, like I mentioned earlier, is normally around the 2 to 5%. But according to the National Association of Realtors, the appreciation levels of real estate have been 6% since 1968, which I don't know if you want to take with a grain of salt. It's not too realistic because of the 2008 crash. There's a lot of outliers in that scenario. So I think it's a better number to go with 2 to 5%. And so when you do purchase a property initially, you just should know that your property, based off the initial purchase, you can multiply that by 2 to 5% each year. And that's the recurring amount of revenue you're going to get. If you hold it for 10 years, you can keep multiplying this, and that's the recurring revenue you're going to get if you ultimately sell it anytime. Next slide. Next, we have government support. So this is what I mentioned earlier. So in the recession today, some investors are afraid of the loss of rent payments since they're prohibited to evict residents if they can't pay during COVID. However, there's this new thing called the mortgage forbearance clause, which protects homeowners and some real estate investors from foreclosure in case they cannot make their monthly payments during the COVID-19 pandemic, So this is really nice for individual people. The government's throwing a lot of money into the sector to try to help tenants as well as investors to also help stimulate the economy. And finally, next we have rental properties, we have small business loans. And this means that rental property investors might qualify for small business loans, which they can then use to cover certain recurring expenses such as mortgage interest or utilities, or even some of these small business loans might actually qualify to go towards some of their tenants' rent, which is really handy. And the government is doing a lot for the sector to help support tenants and just real estate investors in general, which is another reason why you as an investor should jump into the sector. And next slide. And finally, we have lower mortgage rates. So the last thing I want to talk about here today is during a recession, usually governments, not just in the US, all over the world, will try to lower mortgage rates to induce buyers to invest in real estate. This isn't just mortgage rates. This is also interest rates. You can see this as interest rates are all-time low right now. The government doesn't want you to just keep your money in the bank. They want you to go out and spend in the economy and get the economy going again. So in late January 2007, the average rate for a 30-year fixed rate mortgage in the US was 6.25%. And then 2 years later, after the crash in the thick of recession, the same rate dropped to 5.110%. And now the rate is hovering around 2.5 to 3.5%. And that's pretty amazing because it's at a really, really low rate. So if you're looking to buy a house, now is a perfect time to get locked into a 30-year deal where you might be paying one of the lowest interest rates you will in the foreseeable future. That's all I have today. I'm now going to pass it on to my colleague Thong to talk about how to prepare and invest.
Thank you, Alex. Hello, everyone. My name is Thong, and now I would like to continue on how to invest in real estate during a crisis. So the first thing that I think people need to do is to conduct a research. They should get to know the price range around the area that they want to invest in to make a reasonable bid. Also, they should search on the internet for listings and talk to experts such as a real estate agent or a realtor. And the next thing is to make sure that you need to look for an area that has stable economic and job growth. For example, areas close to the downtown, or during the current situation, the areas in the secondary markets with growing population and reasonable cost of living would be better. Also, you should check the property for red flags, such as tax or other liens. You can check these through the court records, and you should also check if the property is suffering any lack of maintenance, since during a crisis, many landlords may not be financially able to maintain the property. The next thing to be prepared is to have a financial plan in place. The current situation makes it hard for tenants to pay rent on time, since they maybe suffer from unemployment or having a difficult time looking for a job. According to Forbes, compared to the March 2020, the rent payments collected in April was 70% lower, and I think this figure is still around during this time. The government policies also prohibit the landlord to evict tenants if they haven't paid the rent. So investors should have planned how to handle late payments and also how your investment will be affected by this. And you should have enough liquidity to take care of the expenses for at least 3 to 6 months. An option that a lot of investors can look at is to invest in single-family properties. The single-family properties have far less volatility than stock and bond. If you look at the chart right beside, you can see that from 1992 to 2016, the line for bond and stock, which are the line in red and blue, it fluctuates a lot. But for single-family property, the black line is quite stabilized, and even during the financial crisis in 2008, it decreased a bit, but then it will resume to its current situation about 4 or 5 years later. The rental rates have also increased steadily since 1985, and the COVID situation makes it really hard for the buyers to see the unit for sale in apartment buildings, so the single-family properties are much easier for them to look at and buy. And with the uncertainty, many people will opt for renting rather than buying, so the investor can collect rent payment. The next thing I want to talk about is to buy the cash flow properties. It is really important to choose the properties with positive cash flow, since they will bring profit even though there may be changes in the housing value. If you choose a property with negative cash flow, it can cause financial distress, especially when you want to lower your rent to attract more tenants. So basically, you should aim for around $200 a month after minus expenses and reserves. Another option to look at is to invest in mobile home park. Most tenants of the mobile home park are retired and they are on a fixed income, so they are more likely to pay rent on time. And according to Forbes, around 75% of mobile home owners expect to stay for 5 years or more because of the cost of moving is really expensive. So it will be a low turnover rate for these kind of properties compared to the 60% turnover rate for apartment. Also, while investing, investors should really get updated with laws and regulations, because right now the situation is really uncertain and there may be lots of changes in the policy and laws about eviction or late rental payments. Investors should really review and follow CDC and OSHA requirements, and you should also contact some insurance providers or some attorneys for further guidance, since we may not understand those law and regulations really well. And also, it should be important to be patient. I think a lot of investors may be intimidated because they have to suffer from lots of expenses and maybe like late rental payment. But experts believe that the real estate market will not be as terrible as in the housing bubble burst in 2000. If you don't want to invest your whole money in a property, you can look at other options such as the real estate investment group. This is a group of investors who will purchase a property through a company. The company will be in charge of managing the properties, maintenance, repairs, advertising, and any tenants issue. So you can also purchase a larger property. Another option is a real estate investment trust. It is a trust or corporation investing in properties using funds from investors, and they need to pay you at least 90% of the income for dividends, so you can enjoy high yield profit and not worrying about landlord issues. Also, it is more liquid compared to buying the whole property, since you can sell your shares. These are all for me, and I would like to give the floor to my colleague, Wesley.
Hi guys, I'm Wesley Swank, and I will be talking about the potential risks involving real estate and the housing market, and some ways to avoid these risks. So first off, these are rather typical risks regardless of the economic climate. I mean, landlords should, there's often times where there may be costs, repair costs, unforeseen maintenance costs, just expenses that they weren't, typically expecting or are not, on a regular basis. And one way to deal with this or propose solution would be to put up more money or capital up front. So you kind of have, funds allocated to deal with unexpected costs or maintenance. And then instead of having to pay out of your pocket or rearrange some assets to come up with money to cover these costs. Another risk is issues between tenants. Could you go back, Tom? Thank you. Another risk is between tenants, and this could be, evictions, legal battles, because a lot of times you have to solve financial problems in a court system with your tenant. And some ways that you can maybe combat this is to screen your tenants very thoroughly before, lending to them or giving them a lease. You want to, really check their credit score, income, financial history, maybe even a background check. And you also want to create a detailed lease with the help of a lawyer so that your lawyer and tenant are all on the same page. So next slide. And this is definitely the most prevalent risk we're facing now, especially in this hectic time of the virus. So obviously the coronavirus cases are in a huge uptick recently. We're seeing a big surge as states are reopening. So as a result, a lot of states are halting their reopening plan. So if they were in phase 2 trying to move to phase 3, they're just staying in phase 2, which is, a lot of businesses are still closed or they have limited occupancy. And some states are even going back to a previous stage to try to avoid the spread of this virus. So what does this mean? This means that businesses in the near future are probably going to continue to struggle. So they should, cut costs as much as possible. Expect that the future will be turbulent. And this ultimately is pretty bad news for workers, because for a business to cut costs, one of the big things they need to do is fire workers. And then also businesses who previously laid off workers are less likely to rehire workers as this virus condition case in the US gets worse. And some potential solutions to this could be to invest in landlord-friendly areas. These areas are usually the earliest to declare eviction moratoriums and for the longest amount of time. So you can see in this graph on the right that the West Coast is typically more renter-friendly, while the southeast region is more landlord-friendly. And we also see New York and parts of the Midwest that are also landlord-friendly. So it might be a good idea to diversify your holdings, your real estate holdings, to areas that are more lenient or just better overall for landlords. And then additionally, a landlord can offer longer leases at lower rates to try to keep tenants residing there for longer to ride out this current recession. And then additionally, investors should test different rental rates that can still achieve a positive cash flow, because it's one of the most important parts is you always need to have a positive cash flow. So next slide. So to wrap it up before we go into some questions, some general advice for business owners is to, expect a rocky road in the near future. It's not looking like we're going to get a vaccine in the near future or a vaccine that's scalable. to the masses in the near future. Some other advice would be, like I said earlier, to try to minimize costs as much as possible, because it's unlikely that you're receiving more business or more profits. So really one of the only ways to stay afloat is to try to minimize costs. And then don't be afraid to take out a PPP loan, because the government is, handing these out to anyone in need. So if you're expecting hard times or currently there, just don't be afraid to take out one of these government loans. And then to real estate investors, I would say to avoid, like Alex said earlier, to avoid luxury areas at the moment, especially New York City and San Francisco, because obviously luxury items decline during a recession. And then, like Alex mentioned, things are becoming more digital. So people are less likely to be required in that city to actually work for that job. So I might say to the real estate investor to maybe look to the suburbs, because people might be, moving or migrating out of the city for cheaper leases and rent in suburban areas. And then to look for an increase in home prices in the future, because of the currently low rates and the stimulus package that we've been receiving. But also, you should prepare yourself for, the worst case scenario of complete fallout of home prices if this virus, persists and we don't have enough funding to kind of keep this economy afloat. So you go to the next slide. So these are some sources, and then these are some frequently asked questions that I came up with. If anyone has any other questions, you can leave them in the chat. So the first one I have is, what direction will lending rates go in the near future? It's pretty definite at this moment in time that rates will decrease, because firstly, the Fed has promised to keep rates near zero for the foreseeable future, I think through 2021. So this almost directly translates to kind of mortgages and loans through housing, and we can expect that those are going to be pretty low because they're trying to encourage economic activity. And then real estate prices, it's kind of tricky right now at this point. I would say if we're able to weather the storm of the coronavirus outbreak, and nothing, the credit market holds up, I think with all this extra cash and stimulus in the economy, we'll see an increase or appreciation of home values. Another question is, what is the impact of the new stimulus bill? Specifically, what implications on housing does this have? And it's kind of good and bad. And in this next week, it could be pretty catastrophic, because we're not really seeing bipartisan support on anything. So the eviction forbearance clauses are about to come to an end at the end of the month, and unemployment benefits are about to expire. So I expect for them to immediately extend the eviction forbearance, but if they don't, then we'll see a mass amount of vacancies and evictions throughout the country, which would not be good. And then additionally, unemployment benefits, it looks like they're going to drop from right now from $600 to $200. And this could have a big impact on housing, leases, rental rates, because people have less cash. They have less access to a stream of money. And so they may not be able to, meet their lease payments or rental payments, which could obviously have some pretty big implications for the housing market. And then lastly, I have, will we see a similar recession to 2008? And I would say kind of, but most likely not. Some similar things we have going on right now are, we still have mortgage-backed securities. Instead of CDOs, which are loans on loans, we have CLOs, which is basically the same thing, but with a different name. But since '08, banks have been required to hold less leverage, and insurance agencies are generally held more accountable so that they have accurate ratings. So and this time around, the Fed has been a lot more active earlier, and they've kind of been able to buy off bad assets from banks and support housing markets and prices. But ultimately, if this does end up being a bigger recession, it won't specifically deal with housing. It'll deal with basically all industries that involve debt: home, auto, credit cards, student loans, because we're seeing a huge increase in debt, especially since 2008. And we're basically trying to solve the problems right now by printing money, which might work in the near term, but later it could result in a currency crisis or something drastic like that. So we probably won't see the exact same thing that happened in 2008, because we know which steps to directly avoid that problem are, but this might push the underlying debt problem to a more drastic outcome later in the future. So yeah, that's our presentation on investing in real estate during a crisis. And if you have any questions or comments, please feel free to email asset@leechandlerenterprises.com. Tong, I think we have the email on the next slide if you want to.
Yeah.
So yeah, that's the email you can contact us at. And yeah, that's our webinar.
Should we end now?
Yeah, I think if there's no questions in the chat, I think we're good to go.
Thank you, Lena. And we will send
Thanks, guys.
Cool. All right. Is there anything else we need to do?
I think we're done now. Thank you.
Yeah, I think it was total about 27 minutes, which I think is pretty good, because I think they said 30 minutes with everything was about what you're trying to aim for.